right, everyone, we are back. Make sure your cameras are on. On, please. All right, make sure your cameras are on. Joel, where are you? All right, cool. All right, so hey, Cheryl. Cheryl joined us. Cool. See you there. So where was I? Okay, so Ed, you wrote Tomorrowland when we were talking about REITs. I just saw the message after I said we were going on break. So yeah, it could be it was a structured REIT as well. Tomorrowland up in the Meadowlands. Absolutely. All right. You guys have any questions regarding the first half of this chapter? If you have any questions, drop them now in the chat before I proceed. I want to make sure everybody pays full attention to what we're going to cover next. Questions? All right. Questions? Cool. Let's move forward. We're going to go talk about taxation of real estate investments. We're going to figure out what taxable income is in real estate, what is the cost recovery or depreciation, gains on sale or capital gains, and how much you have to pay on taxes and capital gains, interest and how you can deduct interest, and then talk about some passive activities as well. Okay. Joel, you got kicked out of Zoom? You're back. You're good. But no, you actually got kicked out and not back yet. All right, so real estate investments are taxed on the income they produce and on the increase or gain when the investment is sold. Right, so these forms of taxation are distinct from ad valorem taxation of real estate, which is the general real estate tax. And taxable income, as we're going to go over right now, taxable income is the gross income received minus any expenses, deductions, or exclusions that the current tax law allows. Okay, taxable income, where you pay in taxes after all the expenses or deductions. Okay. Wow, Francesca, today you turn on the lights. I can see clearly now. Okay. You turn on light and then Denise turn off hers. That's what it is. Oh, that's because you're not home? All right, cool. So never be home again, okay? All right. Cost recovery. So cost recovery, these two words right here, cost recovery, is what we call depreciation. And if you guys remember, I was talking about it in the first half, and we talked about it in a different chapter as well. If you guys remember, the walls eventually need to be replaced. There's wear and tear. The floors eventually need to be replaced. There's wear and tear. The roof needs to be replaced. There's wear and tear, right? So the cost of the investment in improvements can be recovered, okay? So Depreciation allows the income of a property to deduct the portion of the property's value from the gross income each year over the life of the asset. Now, the life of the asset and the deductible portion are defined by law, and in theory, an owner recovers, or the owner recovers the full cost of the investment if it is held to the end of the asset's economic life. Okay? So, as defined by the IRS. At the time of selling the asset, the accumulated cost recovery is subtracted from the investment's original value as part of determining the taxable gain. So let's talk about this for a second. They're telling you that the IRS allows you to recover the cost of improvements, whatever you do in your house. They allow you to recover the cost of improvement. But whatever you recovered, whatever you deducted every single year, when you go sell, they want it back, right? So it's not like they want it back directly. They're going to tax you on the benefit you had of recovery over the years. So you're going to be deducted from your expense because it's a benefit, it's a gain, right? So cost recovery is allowed only, look at this, only for income properties. Only for income properties. Can you do cost recovery on residential? Can you fix the roof and tell your CPA, hey, deduct the roof from my residential home? No. Current Internal Revenue laws says, hold on. Current revenue laws says that nope, you cannot. Hold on, I'm just trying to get him back here. Joel can't get in. Just give me 1 second. Sorry. Sorry. So, where was I? So right now, the Internal Revenue Code or Internal Revenue laws don't allow you to do cost recovery or depreciate your home. Only investment properties or income properties. Okay. We were audited, Mr. With the reward because we changed carpet yearly for my tenant. It is not in his contract. It was a verbal agreement as part of his rent. I'm not understanding. Hold on. Let me go back to your chat. Put it right here. Mr. Badur, you were audited because you changed the carpet yearly for your tenant. It's not in the contract, but it was a verbal agreement as part of his rent. So you're audited because you deducted from your taxes the carpet. Okay. If you don't mind me asking, why would you change the carpet yearly? Oh, now you blame the CPA. Got it. Always like that. Always blame the professional. Yep. Oh, it was the realtor's fault. It was the CPA's fault. Yeah, I see how it is. You told your CPA, I don't want to pay taxes. CPA did what he had to do. That's the CPA's fault. I'm being sarcastic, by the way. Of course it is a CPA's fault. It should have told you and should have known that I don't know what that means, but okay. But the CPA should have told you, yeah, deducting the same thing over and over, it's a little weird. So it might be a red flag. Yeah. Nobody replaces the carpets every year. Now, the tenant is a fun person. I could take that in so many ways that would cause a carpet to be replaced every year. Yeah. No, Lula, not that way. No, not. Yeah, I see you laughing. You gave that face like, oh my God. No, not that way. No. We're PG still. Okay, still PG. It's Friday the 13th, but we're still PG. Okay. So, like they play Twister. Like they have games, they play Twister. That's what it is. They have animals, and they have fun with animals. It could be so many things. But anyway, carpet every year. Did you win the audit? Did you explain why? Mr. Bitter? Ruth just. Yes, great. So you were able to explain why. Great. You won after 2 years. Okay, not bad. It could have dragged longer. But anyway, let's talk about the cost recovery. And no, you don't need to. I see you're still kind of attempting to type something. I know you want to explain what a fund person is, but you don't have to. Okay, you don't have to. Okay? We're good. Let me explain what is the cost recovery. The cost recovery applies only to improvements, not the land. Now, guys, by now, and I know you're going to make a mistake in this question. It's okay. But by now, you should know what improvement means. Who can tell me what is an improvement? Before you answer, stop typing. Stop typing. Before you answer, let me show you something. Before you answer. It says the cost recovery applies only to improvements, and land cannot be depreciated. That's your hint of what an improvement is. Go. Let me know in the chat. What is an improvement? YouTubers, give me your answer. What is an improvement? Zoomers, give me your answer. What's the improvement? Okay. Not carpet, apparently. So far, everybody's making a mistake, and it's okay, right? But my question is, what's an improvement? Some of you got close to it, but still not giving me the right answer. You're still thinking about the one thing that it's not. I mean, kind of. Ruth fell to the same problem. Okay. Something attached to the property. What property? There's 4 people watching on YouTube. Let me know. Ruth just answered. Notes, chapters, in as well. Major renovations adding to the property. What property? What is property? Something that you want to improve, says Joel. Okay. What is property? Property is land. Okay. Property is land. There's personal property and there's real property. What do you mean property is land? What kind of property is land? Stephanie says planting trees. Okay. Lula says structure of the home. Okay. So maintain the home. Okay. So any real estate property. Okay, guys. Most of you are stuck. Most of you are stuck on thinking about the structure. Thinking about the structure. That's what you're stuck. Thinking about the building. That's what you're stuck. Look, an improvement. We have 2 definitions. We have land and we have real estate. An improvement is only to anything built on, under, or through the land. Land itself does not depreciate, but anything that's added, plumbing, for instance, is an improvement to the land, right? A driveway is an improvement to the land. A garage is an improvement to land. A pool is an improvement to land. So anything that's added to the property, remember this? There's a definition of land, which is raw land by itself. And then what they're saying is anything that's added to the land is called an improvement of the land. But in your mind, you guys keep on answering stuff like extending the house, fixing something or rehabbing something in the house. No. It's part of it, but an improvement is anything that's added or altered in the land, in the raw land that's given to you. Okay, so improvement is anything that's added or changed in the land. So if you pave the land, that's an improvement. And the cost of paving can be deducted. Okay? You put a pool there, it's an improvement. You put pipes, it's an improvement. Right? So anything that's human made, it was not nature. Anything that's human made, because land is nature. Right? If a tree was there, so I'm going to go with Stephanie, she said planting trees. Right. So if a tree was there already, nature put it there, that's just land. It's not an improvement to the land. Anything that's altered by humans, right? So there's areas where we don't have palm trees. For instance, they don't grow naturally. If I bring a palm tree from somewhere else into my property and happens to survive, miracle in certain areas, right? If it happens to survive, I improved the land. It was not nature that put it there. It was an improvement. So anything we add to the land is considered an improvement. Got to remember that. Yes, Joel, you were close. Like I said, 90% of the answers were in a different direction. I'm not saying 100% it was wrong. It's just I don't want you guys to think that an improvement, right? And Ruth wrote structural change, restoring, or maintaining a home, like most of you had something similar. I don't want you to think that improvement, right? This is land. I don't want you to think improvement is, oh, I just updated the bathroom, right? An improvement is I fixed the door, right? And yes, that's a bathroom, not a window. We see through, okay? But I don't want you to think that's the improvement. The house is an improvement already. The pipes that run water or sewer to the house are considered improvements, okay? The pool is an improvement. No, that's not a coconut. It's the pool. I swear, that's what it is. Okay? It's an improvement. Anything that was human-made, so man or woman-made, right? It was added to the land is considered an improvement. Can you improve the improvement? Can you fix the bathroom? Can you paint the improvement? Yes, you can. But anything that's added to the land, any structure that's added to the land is an improvement, and any cost of these in an investment property could be recovered. Okay? Land is land. There's no improvement to land. Land is land. Okay? But anything added is. So we can depreciate the cost. All right? Now, how can we depreciate? The word depreciation is knowing the loss of value over time. So depreciation is loss of value over time, right? We covered this before. Loss of value over time. So the Internal Revenue Code says, and by the way, if you guys ever, I love these gurus out there because there's people with so much disinformation on YouTube, on Facebook, now even on TikTok. I have a lot of fun watching TikTok, by the way. Not only because of the dances, right? Whatever. Not only because of the dances, but also because there's people that go live over there as experts, right? And talking to experts, by the way. There's one that argues with a CPA about this right here. So he's talking about how you can depreciate and what can you depreciate. And the first thing that he goes wrong, he says you can depreciate for 39 and a half years. There's one guy that I saw a couple days ago. You can depreciate for 39 and a half years. First of all, it's 39 years, and that's only if it's a commercial property. Let's start there. So non-residential property, 39 years. If it's residential property, rental properties, by the way, not all properties, we can depreciate for 27 and a half years. So be careful, guys. Be careful with those fake gurus out there. It's very important that you know how to weed them out. There's this guy that makes millions of dollars and all of a sudden decides to take a live call, by the way. He took a live call. He started doing this like Zoom. Takes a live call and one of the students asks him, "Hey, how do you calculate the cap rate?" Right? You guys already know cap rate by now, right? Talk about it in chapter 16. Income property determines its value based on a cap rate or return of the rate of return on the property, right? This guy makes millions of dollars selling a real estate course, and he's trying to explain cap rates is the same as ROI on the stock. That's what he tried to explain. So he got caught red-handed, not knowing what a cap rate is. Yet sells millions of dollars, of course, of money in the course. Anyway, gotta love these people. Anything to make a buck, right? Or two. So the max that you can depreciate is 27 and a half years. What does that mean? It means that over the next 27 and a half years, every year you can deduct a portion, right? And there's an example here. So you can deduct 3.6% of the cost for 27 and a half years. So every single year, you can take a portion of your loss and recover it. Okay, that's cost recovery or depreciation. So if you put 100,000, oh no, not only in America, unfortunately. So if you put actually, let me make the numbers even simpler. $275,000. Okay. Okay, and I used to give this example to be easier to understand, but here, since they have the percentage, I'll show it to you. But $275,000 was the cost of rehabbing, or the cost of building, or the cost of whatever, the physical cost, right, of the improvement, 275. I can depreciate 27 and a half years. What does that mean? I divide this amount for 27 and a half years. That means that every year I can depreciate based on $10,000. You guys understand? Every year I can tell the IRS I lost $10,000. Every year I can say to the IRS I lost $10,000. And the IRS says, okay, out of those $10,000, you can recover 3.6%. Out of those $10,000, you can recover in your taxes. Like, I allow you to deduct from your taxes 3.6% of that. It could be more based on a few other things, right? And I'm not a CPA, so I'm not going to give you all the details here, unfortunately, right? But definitely consult with a CPA. But what it's saying is, I put this amount of money into rehab. I can divide it by 27 and a half years, which is what the IRS says. Every 27 and a half years, because of the usage of residential property, every 27 and a half years, half or more of the property is going to have to be replaced. Plumbing, siding, roof, definitely, right? So it has to be replaced. So they allow you to recover a portion of that money over 27 and a half years. You guys got it? So what is depreciation? Is loss of value over time. Value of what? Of utility. Value of utility, the walls, the ceilings, the roof, all that stuff. Do you have to have proof? Well, depending on what you're claiming, yeah. You don't want to be audited for a carpet. But yes, I'm sure Mr. Badur, to win the case, he kept all the records, right? That's how you know? Sucks, doesn't it? Guys, this is a business. Real estate is a business. In every business, you should keep records of all your expenses. All of them. In real estate, since you're going to be part of it as realtors, at least keep records of all your expenses. All of them. If you don't have an app to do that, QuickBooks Self-Employed is a great app to use. It counts the mileage. You can scan your receipts. Everything's there, integrated for you to send to your CPA. And the CPA is going to love you, by the way. Love you. Everything is ready for them. Okay? It counts the mileage. As soon as you start driving to a client, it asks you, was this business or was it personal? If it was business, please attach the name of the dealer, the client, or whatever. Gas, electrical, like whatever you want. Put it into that file. Keep records. Yes. They might demand proof. If you ever get audited, keep records. QuickBooks Self-Employed. That's what it's called. Okay. Now, again, as it says here, the proper method of depreciation should be determined by consultation with qualified tax advisor, or as we call them, CPAs. Not a discussion to have with me, or with your cousin, with your father, or with your daughter, right? It's a discussion to have with a tax professional. By the way, tax professionals, just like doctors and just like everybody else, could be wrong. Always get a second and third opinion. Just saying. All right, next. We're going to talk about gain on sale. When real estate, whether non-income or income, is sold, a taxable event occurs. If the sale proceeds exceed the original cost of the investment, right, subject to some adjustments, there's a capital gain, right? Capital means a lump sum gain, right? And that is subject to tax. Now, if the sales proceeds are less than the original cost of, like you lost money, then it's called a capital loss. It's a lump sum loss. An investor can sometimes defer or postpone. So this is postpone. Defer is delay or postpone. The reporting of gain or loss. So you want to know how not to pay taxes right now on the $100,000 that you just made on the sale of this house? You want to know how to do it? Well, one of the ways is doing a deferral. It's not like you're eliminating it, but you're deferring. You're postponing for later. You're not paying now, you'll pay later. Okay? And that's called a Section 1031 exchange. Section 1031 of the Internal Revenue Code. So why can you defer if it's an exchange? Well, let me ask you something. These two are the same, correct? You guys see it? Okay, two mouse, right? Or mice. Two mice, right? Isn't it weird, by the way, just fun fact. If you have a house, you say houses, right? In plural. If you have a mouse, you say mice. Why don't we say heises when it comes to, or heis when it comes to house? Makes sense. Anyway, just have fun. English. So we got two mice right here. Only in America, I know. Not all houses are homes, but all mice are mice. All right, so we got two mice right here, and this is yours and this is mine, right? This is yours, this is mine. If I give you this one and you give me this one, there was an exchange, right? There's an exchange of value. Exchange of value. That means they're pretty much in the same value. If there's an exchange of value, did I make any profit? No. See, you only consider making profits. Did I get the right mouse? Yes. Okay. You only consider making profits if you cash out. So if you don't cash out, right? If you roll over the money, instead of cash out, if you roll over the money instead of a cash out, then you exchanged. You did not make any profit. Cash out, profit goes into your pocket. Roll over into the next property or exchanging with somebody else, that means you made $0 in the sale of the first property. You understand? So I had a mouse and I saw another one. This mouse made me X amount of dollars, or house, right? X amount of dollars. And instead of putting that money that I made in profit into my pocket, I saw another property and I took the money from the sale of this one and I dumped into the next property. Because I dumped it right away, I did not cash out. I did not profit. It didn't come to my pocket for now. Okay? I still have to deal with the taxes, but again, because I rolled over into the next property, only later when I sell the second property is when I'll have to pay taxes on the income, on the gain. All right? So again, it's the rollover. In fact, in one of those books that you'll read, if you ever buy the books in my library there, if you ever read the books, there's one of them that talks about, very simple, a great strategy, which is how to never pay taxes. Very simple. Defer, 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 die. Simple as that. Keep on deferring taxes. Keep on rolling over to the next property, the next property, the next property. Then die. Right? Make sure you have insurance so you protect the loved ones that stay behind. Instead of paying the IRS ridiculous amount of money, invest in life insurance, and there's greater return for the people that stay behind. Okay? I'm going to address not the message there. I'm going to address the other one. Mr. Badur said, doesn't it fall under capital gains? It's a capital gain, but it's a deferred capital gain. You'll pay later, not now. Okay? So as far as Lula's comment, which I'm not going to post or talk about right now so we don't get political, declaring a loss is a little different than deferring. Declaring a loss is a little different than deferring. Combining both, yes, will lead you to pay $750 in your taxes. That's what you're saying. Yeah. The tax laws are there. If you don't use it, it's because you don't know. That's the problem. You don't know. So you need a good CPA. Okay? And Joel keeps on insisting, which life insurance? In this case, it could be any type of life insurance. You keep on insisting, huh? Ed, how much time after you sell the house? Great question. I'm going to show you right now. Yep. So, first of all, what type of properties can you exchange? Can it be your home? No. It has to be a like kind. So it's either investment or income property. There's two different values to this. So like kind properties could be, you can roll over, okay? Now, to qualify for Section 1031 exchange, there must be a legitimate exchange of the asset involved. The property being transferred must have been held for productive use in the trade or business or held as investment, and must be exchanged for property that will also be used in a trade or business or be held as an investment. Very important. Okay, the tax is deferred until the investment or business property is sold and not exchanged. So the moment you stopped rolling over to another property, the moment you cash out, you get taxed for all those previous properties, gains that we had. Okay? Unless the final one is a huge loss. Wink, wink. Okay? The final one is a huge loss, which would cover, offset the gains. Right? Joel laughs. All right? Listen. By the way, I'm saying this as a joke, okay? Don't do this stuff. That's also called tax evasion if you plan it. Okay? If you plan to make millions of dollars, right? If you plan to make millions of dollars and then have that one business that loses all those millions that you made, right? So you don't pay taxes. It's called tax evasion. Well, if it was premeditated. If they can prove when they audit you, if they can prove that it was premeditated, then otherwise you'll get away with 16 and a half years of not paying taxes and then 1 year of paying $750. All right. Where was I? Oh, Ed was asking how long. Okay, so I just wanted to finish this section. So for a rollover, I don't know why they don't have it here in this book when it's asked, but for a rollover, once you sell, this is the timeline. Actually, from the closing on property 1 and the closing on property 2. Okay, from closing to closing. You closed, you made money. You have 45 days to identify the next house. You have 45 days to identify the next house. Okay? And you have a total of 180 days to close. So 180 days from when? From the moment you closed yours. There's a total of 180 days. So 6 months to roll over the money. Okay? To roll over. By the way, the question that you might be thinking also is 401ks, right? So the one way to adapt this is 401ks. So 401k, if you leave your job, you can roll over your 401k to another 401k or another variable investment like a 401k. And they also give you the same amount of time. You have 6 months, so 180 days to cash the money out and dump it into a different investment. That's if you don't want to pay taxes on your gains. So can you cash out your 401k today? You can. Can you dump it in 6 months or within 6 months into a different product? You can. So the rules apply to within the Section 1030s, right? Section 1030s, 31, 32, 33, and 34, and 35 of the Internal Revenue Code. It says exactly how long you have and what type of investments could be rolled over into new investments, okay? All within 180 days, 6 months, if you don't want to pay taxes. All right, Lula, what if you already have 2 houses? What do you mean? If you're selling this one, you have one less house. This is for any sale. As long as it's an investment property, it's for any sale. So if I'm selling property B, right? Property A is where I live, and I'm selling property B. Property B qualifies as an investment property to buy property C. You're just rolling over into property C. That's it. Ed says that money I can put in my bank account. What are you talking about? The moment you put in your bank account, you pay taxes on it. That's it. The moment you put in your bank account, you pay taxes on it. So the money is held during these 180 days. The money is held in escrow. So you don't touch it. It's with a third party holding the money until the closing. You don't touch the money. The moment you touch the money, you pay taxes, period. Okay? What about a pension? So, again, it's under the sections 1030s of the Internal Revenue Code. So can you roll over the money that's in investments? Investments, yes. Depending on, for instance, I cannot roll over from a 401k to a single, like a term policy, a term life insurance policy. I cannot roll over from a variable product to a fixed product because then I have to pay taxes on it. Okay, so it has to be like kind. If it's a variable product, it goes into a variable product. If it's an income property, it's to an income property. Okay, like kind, same structure. Ed, no, it's not 30%. It's 25% max if it's within a year. 25% max, and if it's more than 1 year, they're holding the property, then you pay up to 15% on those capital gains. Lewis says investment property to defer. It doesn't matter how many you have. What matters is at the sale of property 1 and you're buying property 2, right? Within the sale of this one, whatever profit you had, you can have, okay, so this is property 3. Okay, you got 2 properties. You sell property 1, right? And you roll into property 3. The gains on this property is exempt. Now you sell property 2 and you roll into property 4. The gains on this one is exempt. So you can play this game all day long. Doesn't matter how many properties you have. They just have to be investment properties at the time of sale. Keyword at the time of sale. They have to be investment properties, and you just roll over to the next one. So you can do this for as many properties as you want. You're just rolling over the money. You're not touching it. Okay? You guys good? Give me a thumbs up if you guys good. All right, perfect. Tina. So if you sell your house, they will tax you on your profit. Okay, let me address that. If you sell your house, like home where you live, it's not an investment property. So there's exemptions for investment properties, and that addresses also Joel's. Okay, if it's your home, there's exemptions of up to $250,000 if you're single, or up to $500,000 if you're married. So you don't have to pay state or federal taxes if it's your home. Okay? But if it's an investment property, you don't have that exemption. What you can do is roll over to the next property. You can defer to the next property. Okay, so this is separate. Yep. That's it. As many times as you want. These are separate things, okay? All right, next thing we can deduct. Mortgage interest. So mortgage interest is deductible. Doesn't matter if it's a residential or if it's an investment property. If it's the house where you live or not. Every time there's interest, that means you're paying somebody else for something, right? As a benefit. So you can deduct. The principal is not deductible, but the interest is deductible. Okay? Principal is not deducted, but interest is always deductible. Okay. Next thing we have is passive activities. What is the difference between passive and active? Okay. Passive is you're limited. Okay. You're like a limited partner. Somebody else is managing the property, right? Is the managing partner of the property, and you're just collecting income passively, right? So you're not directly participating in it. So passive activities are deducted in a different way. It's different than credits, which we'll talk about later. So one thing that you need to know is this. Joel, yeah, like a silent partner or a limited partner. Yep, limited means silent. Yep. So, but one thing you need to know about passive, if you're a limited partner and there's a loss, right? Usually when we lose on one side, we're able to deduct from the gains on another. When you go to do your taxes, you can offset so you don't pay as much gain, right? The thing about passive losses is that you can only be used to offset income on passive gains, all right? So there's two structures for the IRS. There's the active, and there's the passive. Any gains on the passive can be offset by losses on the passive. Any gains on the active can be offset by losses on the active. So wages, for instance, you have to pay at 30%, let's say. Wages you have to pay at 30%. But you had in an active business, you're the general partner of a property, let's say, right? You're the general. So you're an active partner, right? And you lost minus 30%, okay? In an ideal world, it's not like this, so I'm just giving you an idea of something here, right? It's not exactly like this. Consult a CPA, but I'm just putting numbers out there as very much an illustration of what should happen. If you made money and you have to pay 30%, then if you lose 30% in an active participation in the business, then technically you would pay 0% in taxes, okay? And this is very common when you were a business owner. There's expenses. You have losses in your business. Even though you made $100,000, you had X amount of dollars in losses. And sometimes we pay $0 in our taxes as independent. Sometimes we even get money back because of the losses. You guys understand? So these directly offset, right? So active income, active wages, whatever, they directly offset each other, right? It's not 30 to 30, the ratio, but active to active. Passive losses, let's say rental properties, right? You made 30%, but then you got sued. Just an example, you got sued for $1 million, and that represents another 30% loss. Okay, so minus 30%. All right. Can we use these 30% loss on the million? Can we use to offset this one so we get money back? No. Passive losses only apply to passive gains. So you can reduce what you have to pay on these taxes. Okay? Obviously at the end they're going to funnel and right? They're going to funnel and get together to a value they have to pay or not. But they're all weighed in different percentages. Okay? So what we're trying to say here is, could you have a passive loss offset directly these wages? No. But this passive loss here could represent $5,000, let's say. Okay, could represent a $5,000 loss. This is now going to be calculated, so you had a loss of $5,000. And I'm going to give you an example. Again, this is not the right numbers. But this $5,000 loss could represent, let's say, 2% of it will be quantified here in your gains, in your final gains. So you had $10,000 in gains. What did I say? 2% of that loss will be applied here, right? So it's minus $100, right? So minus $100 is what? Wow, what percent? $100 is what you have to pay. So you still have to pay $9,900. All right. So that's your final number after everything's adjusted at each individual percentage in each individual category. This is why I'm not a CPA. I don't want to know about these numbers exactly how they run. Okay? But at the end of the day, you had a huge loss over here. They only qualify 5,000 as the actual loss. And from those 5,000, you can only take 2% as an example to apply here at your gains. You guys understand that? So active losses can offset active income. Passive losses can offset passive income only. They're separate classes. Any questions here? Give me a thumbs up if you're good. Great. Okay, now we're going to go, we got 5 people watching. Okay, cool. Got thumbs up from Cheryl. Awesome. Cool. 5 people watching. Whoever's watching, if you have any questions, drop them now. So investment analysis of a residence, appreciation, deductibles, tax liability, and gains, tax exclusion. So you guys are going to notice the difference of a residence and an investment property. The only thing we have here is appreciation. There's no income. The residence. There are certain deductions that we can apply for tax liability and gains on the exclusion. So let's look at this. Let's start with appreciation. Appreciation is the increase in value of an asset over time. We got that, right? We bought it for $100,000. 10 years later, it's worth $150,000. That's appreciation of $50,000 over the years. Okay? So how to figure out appreciation? Very simple. Current value today, 10 years later, right? Minus original price, that's the total appreciation. It doesn't get any simpler than this. If they ask you, what was the appreciation? Well, today's worth $400,000. That's what it's worth today. I bought it for $300,000. How much did it increase? Well, total appreciation was $100,000. Simple. Okay, this math is going to be the simplest ever right here. If they ask you, how much was the appreciation? How much was the appreciation in terms of percentage? What was the appreciation rate in terms of percentage? Well, total appreciation can be stated as a percentage increase over the original price by dividing the estimated total appreciation by the original price. In this example, 33%, because the total appreciation was $100,000. The original price was $300,000. So 100,000 divided by 300, I had a 33% increase or appreciation over the years that I had the property. Okay? You guys good? I'm going to pause several times here with the math. You guys good so far? Great. This part is easy, right? Now, what if they're asking you, this is the total appreciation, right? What if they ask you, what is the appreciation per year? Well, how many years did I have the property? 33% divided by the years. So if I had the property for 3 years, 33% divided by 3 is 11% appreciation per year. Simple. In yellow, Lula, it's almost like your savings account. Right? Gotta love real estate. These are real numbers, by the way. Very possible to get 11% returns in appreciation only. 10% return on the property. Very possible. But depending on the market demands, depending on the fluctuation, right? The markets. You guys remember when we talked about real estate market, I told you guys that properties here in Newark, that you haven't done anything to them, they increased almost $200,000 in value. They were worth $300 5-6 years ago. Now they're worth $500 without doing anything. Do the math of the appreciation there. Do the math of the return on your investment. Right? Of course, this is a crazy thing, but understanding markets, you know when to put money into the market and when to take money out. Simple. Again, the difference between real estate and stock market, that you can see way ahead and be ready for it. Big difference from stock market. Stock market is in the minutes. Here, real estate is way ahead. All right. Having a lot of fun in my class. Forget to pay attention. The exam comes, you cannot have company around you, just saying. Anyway, back to this. What is the primary benefits available to a non-income property? It's sad, by the way. It's sad, and I'm sorry for those that have non-income properties. It is sad, but the primary benefit, and sometimes the only benefit, is the annual deduction of mortgage interest. So, is it good to pay something cash and save all the interest? No. Never buy your house 100% cash. Leverage. Because then you can deduct interest every year. So instead of paying 6% on the mortgage rate, instead of paying 6%, you're actually going to pay 4% as an example. Because you deduct every year for this. So you're still going to save money. But at the end of the overall, leverage, always. Never pay cash for a house for anything. Good debt, not bad debt. Okay? The seller of the principal residence may owe tax and capital gains that results from the sale. Principal residence, by the way. And the IRS defines the gain of a sale of home as the amount realized or made from the sale minus the adjusted basis of the home sold. The amount realized or the amount made is known as the net proceeds from the sale and is expressed by the formula. Very simple. Gross sales price minus the costs of the sale. So closing costs, for instance, commission, etc. Okay? So after the sales price, we deduct commission, closing costs, whatever, right? And the net amount is the amount we realized, the amount made, right? It's just like your paycheck. Just like your paycheck. The gross sales price is what you wish you got, but then you got to pay the realtor, got to pay closing costs, the city, recording, whatever, and then here comes your paycheck, and you're like, oh, I sold it for $500,000, I made $20K, right? So the $500,000 is what you wish you got, but then you had to pay stuff at the time of the sale. What was your net amount realized? Okay. So the sales price is the total amount the seller receives for the home. This includes notes, mortgages, and other debts that the buyer assumes as part of the sale. The cost of the sale includes brokerage commission, relevant advertising, legal fees, all the costs that came with the property, running the property over time. Certain fixing up expenses, as discussed further below, and these can be deducted from the amount realized to derive at the adjusted sales price for the purpose of postponing taxation on gain. Here's an example. Larry and Mary, okay, sold their home for $350,000. Okay, their selling costs, including the commission paid, they paid broker Betty, and amounts paid to inspectors, a surveyor, and the title company, amounts to 10% of the selling price, or $35,000. So how much did Larry and Mary walk away with? Well, $350,000 was the sales price minus the fees. They walked away with, or they made, or realized $315,000. Not bad, right? Not a bad payday, right? Now, adjusted basis. First of all, the word basis means cost. The word basis means cost. Sorry, that looks like a 6. Cost. Okay? Basis means cost. How much did I put in to the property? Okay? The cost of this property. How much did I put in? And by the way, this is the same thing for other investments. So if you have a 401k, as an example, you want to roll over the 401k, right? Or you're going to withdraw and you have to pay taxes on your 401k. They're going to look at how much money you put in, right? And then after expenses, how much money are you getting? What is the net? The basis is always the money you put in. Okay? Basis is the money you put in. The gain is any money that's above the amount you put in. Okay, so if you put $10,000 into something and you got $12,000 out of it, right? Then you pay taxes on the $2,000 difference. Not on the 12, it's on the 2. Okay? Because $10,000 was the cost or the basis. Okay? So right here it says basis is a measurement of how much is invested in the property for tax purposes. Assuming that the property was acquired through purchase, the beginning basis is the cost of acquiring the property. Okay, the beginning basis, the initial basis. The costs include cash and debt obligations and such other settlements costs as legal, recording fees, abstract fees, so the title, surveys, charges for installing utilities, transfer tax, title insurance, and other amounts paid that the buyer pays for the seller. So the beginning basis is increased or decreased by certain types of expenditures while the property is owned over time. Okay? So the initial basis is how much should I pay for? Over time, if I had capital improvements right here, capital improvements, right? Then we're going to adjust the basis. See, capital improvements are additions that we're putting in. Okay? So how do we calculate the basis? Beginning basis is the purchase. That's the beginning basis. And then we add capital improvements. Then we have to deduct from the these two, the bases. We have to deduct exclusions or credits that we collected over the years. Exclusions or credits like depreciation that we collected over the years. And we reach the adjusted basis. So let's translate this into numbers. For example, Mary and Larry originally paid $200,000 for their home. Remember, they sold for $350,000, right? But originally, they paid $200,000 for their home. They spent an additional $10,000 on a new central heating and cooling unit. Their adjusted basis at the time of selling is $210,000. Okay? So they bought it for $200,000. That's the initial or beginning basis or cost. Plus improvements. How much money did they put in? $210,000. Are we good so far? Okay. Just want to make sure because it's going to get a little complicated. Okay, so the total amount of money put into the property between purchase and improvements is added. Okay. So the gain on the sale of the primary residence is represented by a basic formula, which is amount realized, net proceeds, right? The 315 that we saw, minus the adjusted basis of 210, and that is the gain on the sale. Now, don't forget, there's an exclusion. That's what it says. The gain on the sale, if it does not qualify for the exclusion, then it's taxable this way. I'm going to go over in a second. Don't forget, if it's single family, if it's your primary residence, you don't pay up to $250,000 if you're single, or up to $500,000 if you're married. But if this is an investment property, as an example, this is how things are calculated. We sold for $350,000. We had the costs, closing costs and commission costs and whatever, of $35,000. So the net amount of the sale, was $315,000. $315,000. By the way, it's very important you guys understand what I'm going through right now in this example, because a lot of sellers are afraid of selling, believe it or not, afraid of selling because they have to pay taxes on the money they make. And I'm going to show you right now how you can help them by understanding this, how you can help them understand you don't pay taxes on the whole amount that you're going to net. You pay taxes on the amount that you're going to net minus how much money you put in. So I just had somebody here last week, and he's saying, oh, I'm going to make roughly $400,000. I'm like, okay, cool, that's awesome. But how much money did you put into the property? Well, I bought it for $200,000 and I put another $160,000 into it. So you're going to pay taxes on $60,000. Simple. It's like, what? Yeah, because you put $200,000 into it as an example, right? I'm sorry, you bought it for $200,000, you put $160,000, so that's $360,000. You're going to walk away with $400,000, right? But you put $360,000. $360,000. So it's $40,000. That's what you're going to pay taxes on. That's the difference. He's like, oh my God, we're selling now. So supposedly he's coming back to sell the property. But that's what it is. They don't have to pay taxes on the amount they net here. It's not on the $315,000. They pay taxes after expenses. So let's look at this. We bought the home for $200,000. We put $10,000 into it. So that's $210,000, right? They made $315,000 on the sale, but they spent $210,000 on the property. This is the taxable gain. $105,000. This is the taxable gain. $105,000. So if it's a short-term holding period, you pay 25% of that. If it's a long-term holding period, you pay 15% of that. Doesn't matter if it's 15 or 25. it's always better than paying 15 or 25 of that. Right? So your payment, your gains, are based on the money after your investment. Whatever you took home minus your investment or basis, that's what you pay taxes on. Okay? Any questions so far? Told you I'm going to go very slow now. YouTubers, questions? Consumers, questions? That's the way for flip houses? Well, flip house is a little different because when you flip a house, usually you try to flip within a year. So you're gonna pay taxes on up to 25% on that flip right away, right? So a little different. That's why before you get into flipping homes, you need to understand the corporate structure or the ownership structure you have. Are you going to put it as an individual name? Or are you going to put it in an LLC? Right? Are you going to have an S corp to hold to be a holdings company for all the LLCs? So there's a lot of things involved in that for you not to have to pay that much in taxes. Okay. So again, this is why a CPA is so important. Okay. If you guys don't have one, I can always recommend one for you. Okay. All right. Next. In the case of Mary and Larry, their capital gain was 315 minus 210, or 105,000. They will owe tax on this amount in the year of the sale unless they qualify for the exclusion described below. What is the exclusion? Capital gain tax exclusion. What is the exclusion? Tax law provides an exclusion of up to $250,000 for individual taxpayer, or $500,000 for married taxpayer. And you can apply, if this is your primary home, this is only for primary homes, okay? You can apply for this every 2 years. Every 2 years you can apply for this. Provided that you own the property for at least 2 out of the previous 5. Own the property for at least 2 out of the previous 5. So you've lived in the property for 5 years. I'm sorry, you own the property for 5 years, right? And you used and lived in the property for at least 2 years. Okay? So you must have lived in the property for 2 years. You have to sell it right away? No. You can keep the property, move on to the next property. So you lived there for 2 years, and you went to live 2 years or 3 years in the next property before you sold this one. I don't know if you guys understood, but pretty much if you don't want to pay taxes at all, just keep moving every 2 years. That's it. That was the concept here. Okay? Every 2 years you can apply for this. Yep, Larry and Mary, they're excluded from taxes on the 105. Even if they were single, they would be excluded. In this case, they're married, they're definitely excluded. S corp is taxed like a part. So there's different levels to the S corp, and how you are being taxed. The advantage of an S corp is that you can claim yourself as an employee. With an LLC, you pay self-employment taxes. With the S corp, you can be an employee of yourself. So, where were we? Okay, you got it. Cool. In this scenario, the losses are not deductible, and there's no carryover for any unused portion of the exclusion. Okay. The postponed gains from the previous home sale under the earlier rollover sales reduces the basis of the current home if that home was qualifying replacement under the old rule. All right. Next. A lot of stuff, right? A lot of stuff to learn, technical stuff to learn today. All right, next, what we have? Investment of an income property. Income property. Investment analysis of income property. Let's talk about cash flow. All right. Before we talk about cash flow, okay, I want to ask you guys, what do you guys think cash flow is without reading? What do you guys think cash flow is without reading? Money moving. The cash is flowing. YouTubers, what is cash flow? Participate. Help me out. Lula says money constantly coming in. Part of it, not all of it. Ahmed says all the money's moving like a cash flow sheet. Kinda. Celine's the money coming in after all the debts. Okay. I'm gonna reword that to what Ed just said. All right. So Cheryl, I see you, and I'm gonna raise you with Ed's words. It's the money you got left after expenses. So let's combine these two. It's the money you got left after all the debts. So money comes in, money goes out, right? So income minus expenses, whatever's left over is called cash flow. Now, hopefully, it's a positive cash flow. But you could also have a negative cash flow, right? If you're paying more than what you're getting in, it's negative. If you're receiving more than what you're paying out in expenses, it's a positive cash flow. So what is cash flow? Is the money left over after paying all the debts. In the library, you guys are going to see this book. If you haven't read it yet, okay, I highly recommend you read this book. Joel, you just got it, right? Right, I saw that you posted the other day. Read this book. So Rich Dad, Poor Dad, great book. Talks about how to make money work for you versus working for money. That's the different mentalities between the rich dad and the poor dad. His real dad and then his friend's dad taught him everything about making money work for you. All right. Now, this guy, Robert Kiyosaki, also created something called cash flow game. Okay, the cash flow game. All right, guys, search for it when you can. The cash flow game is a board game. I call it Monopoly on steroids because it takes the game of Monopoly, which is already like a real life application, and turns it into, oh wow, I've been in the rat race, right? I was just playing a game for fun, but now it shows you I've been in the rat race. This is our real life events, right? It really talks about, see, Monopoly only talks about real estate. Cash flow game talks about stocks as well. Talks about expenses that you have, like you have a baby, like it's like the life game for kids. I don't know if you guys ever played the life game for kids. It's the same thing. So it helps them understand how life works. And the goal of the cash flow game, right? The goal of the cash flow game is that it has something here in the middle, okay? And that's the hamster wheel, right? That's why it's called getting out of the rat race. And then around it is the profit. Okay, so we are here most of the times. And we just go around and around and around and around, which is working to pay bills, working to pay bills, working to pay bills. And then you reach retirement, right? And there's not enough money to even pay bills, right? So you outlive your money. Big mistake. What this game helps you do is get out of the rat race, right? Understand the concepts, the basic concepts, get out of the rat race and go into the success or income, make the money work for you versus you working for money. That's the difference. Being in here or being out here. Okay. So cash flow gain. Very, very important for you guys to remember that. Okay. So the cash flow is the difference between the actual cash flowing into an investment as revenue and out of the investment for expenses, debt service, and all the items. So cash flow, 60, you already went to check? $69.97 on Amazon? Listen, I know there's cheaper, so go look for it. But it's worth it, I'm telling you. Or you can play online for free. Or you can get the app for your phone and play there if you want. Bucks or whatever. Anyway, I make no money out of this, so I'm just really, it's to help you guys, not me. Okay. Cash flow concerns cash items only, and therefore excludes depreciation. It's not a cash expense, which is not a cash expense. Pre-tax cash flow, which is pre-tax cash flow. I'm sorry. Or cash flow before taxation is calculated as follows. Okay. So we have potential rental income. You guys remember this? Potential rental income is assuming 100% occupied. Minus vacancy collection losses. This is different than calculating the cap rate, but at least you guys should be familiar with this already. Potential rental income is assuming it's 100% occupied. Vacancy and collection losses is based on experience. We know how much we're going to lose. For tax purposes, it's the final number, actually. It's knowing how much we lost this year. Okay? And that brings us the effective rental income. If we have vending machines, if we have, let's say we have laundromats in the bottom, the coin-operated laundry machines, that's additional income, so we put it here. And that gives us the gross operating income. Okay? Then we deduct expenses. Then you deduct expenses and reserves. What are reserves? See, for tax purposes, if we put money aside, just in case something happens, that's a reserve. We're reserving money. For tax purposes, that money is not in our pocket for usage. It's set aside in the company, in the business, right? We put aside. So therefore, it's not used for, it has to be deducted. It's not used as a profit, it's used as a deduction. And that reaches our net operating income. Net operating income. Why? Okay. Very similar to cap rate. Just that in the cap rate, we don't talk about debt service. Here, we deduct debt service. So mortgage, for instance. We deduct. Okay. If you guys remember the income approach to figure out the cap rate, right? It's NOI divided by cap rate gives us the value, right? Or NOI divided by value gives you the cap rate. Debt service is not included. But here we're trying to figure out taxes, how much you pay in taxes. So the pre-tax cash flow, we include debt because we want to know how much money is coming into my pocket at the end of the year. Okay? So let's talk about that in numbers. Here's the pre-tax cash flow. $70,000 is what we expect if it's fully rented. $70,000. Okay? Minus vacancy, we lost $4,200. Okay, Tina, here's a good example. we lost 4,200. Why? Because somebody did not pay the rent, or when they left, I spent a month or 2 months without renting it. So I lost 4,200 as an example. Okay? And that gives us the effective rental income I actually made was 65,200. Now I also made $2,000 on top of that. What do they have here for the 2,000? Equipment rental. That's what they have. Okay, equipment rental. But it could have been the coin-operated laundry machines. An extra $2,000, right? And our gross operating income, what we get every year, was 67,800. The expenses to keep the lights on, so utilities, management, all that good stuff, is $35,000 a year. And we put 10% of that aside every year as reserve. So I put 3,500 aside every year. So how much actually came to my pocket? How much actually came to my pocket? The NOI was 29,300. Okay? 29,300. But then here's the mortgage. The mortgage, I paid $20,000 this year in mortgage. So what was my positive cash flow after paying all the debts? What was my positive cash flow? This is pre-tax. I haven't paid taxes yet. So 9,300 is my positive cash flow for the year. So my taxes are going to be based on that. There's a little bit more, okay, for us to figure out exactly how much money we gained. Let me know if you're good so far. Give me a thumbs up. Okay, I'm going as slow as I can to make sure you guys get it. If you have any questions, YouTubers and Zoomers, if you have any questions, make sure you ask or stop me. All right. So your tax liability, so how much you have to pay in taxes, right, for the property is based on the taxable income instead of the cash flow. What is taxable income? It's not cash flow. Okay. So taxable income, right here, taxable income is the NOI, which we figured out before, plus the reserves, minus interest that we pay on the mortgage, right? Minus depreciation. That is taxable income. So we only apply the tax rate at the end. Whatever our tax bracket is for this type of property, we apply at the end. So here's an example. We know from before that the net operating income was 29,300, right? 29,300. We put 3,500 in reserves, right? So our tax liability, we need to add the 3,500. But we paid $10,000 in interest to the mortgage. We paid $10,000 in interest to the mortgage. So we added 3,500, but we deducted 10,000 in interest. And look what we're also deducting. Depreciation, the cost recovery expenses, depreciation. This year, I can depreciate $22,000. I depreciate $22,000. Right? We're not CPAs, so you don't have to figure out how that came along. Right? It was given in the question right here. They give you all the numbers somewhere here. Right? But we depreciated $22,000. So how much did I actually make? Taxable income versus cash flow. Taxable income versus cash flow. That's how much I had to pay in taxes for the money I made this year. Right? I'm sorry, I'm going to pay taxes based on that money versus the 9,300. That's the taxable income. My tax rate for this is 24%. So I pay, out of all this, I made 9,300. You guys know that, right? 9,300. But I have to pay only $192 for those $9,000 I made this year. Okay? So let's talk about something real quick. This is for investment properties, right? It's the same as having a business. We can deduct expenses, bunch of expenses. And even though we made $20,000, $30,000, $100,000 this year, right? There's expenses. I made $29,000 right there. I only had to pay $20,000 in mortgage. So the net that we got was right here, $9,300. But I'm not paying taxes based on $9,300 because of interest, because of depreciation. What I really pay taxes on is $800. For businesses, it's the same thing. That's how we can claim so much lesser than being a W-2 employee. And look, I'm not telling you to quit your jobs. That's not what I'm saying. Okay, anybody watching this? I'm not telling you to quit your jobs. I'm just showing you how it's taxed different. If you're a business owner versus, or entrepreneur versus an employee. As an employee, work and you pay based on the wages that you've made, but the employer deals with all these expenses, deals with all these burdens, right? That's why they can declare the losses. You can't, right? So you'd get taxed based on the $29,000 you made if you're a W-2, but if you're a business owner, the $29,000 you made, then we can depreciate or offset with deductions. Just a quick example how these two compare. Investment is what makes you less liable towards the IRS. Want to know how to reduce the amount of money you pay the IRS? Invest in real estate. Invest, not homeowner, right? Invest in real estate. Or open up a business, or both. Simple. Okay? Look at the difference. 192. You guys can do the math if you have to pay 24% on the 9,300. You can do the math if you want. But I know it's way more than 192, right? Okay. Ahmed, cost expense, was that the 3.6? Yeah, that's the depreciation, correct. But it's not a direct relation to what's here, is what's allowable based on the improvements you've made. Okay, so the $22,000 is not based on what we purchased. Okay, it's what's allowable. So that's to your CPA, right? They'll ask you questions like, hey, did you put any improvements to the property? How much did it cost you? And then they apply that 3. In this case, they put a random number. $22,000 is what we were able to declare. Okay? And yes, for 27 and a half years. All right? So, how do we figure out the after-tax cash flow? Very simple. $93,000 minus tax liability. I don't know. They made a mistake here in the number. But $224. How much do we get at the end of the year? $9,076. That's the net, full net. Nothing else I have to pay on it. That comes to my pocket. But yeah, I know. The $224 is off. The point is still the same. Pre-tax cash flow was $9,300. Then our tax liability was way less than that. All right, any questions, guys? Give me a thumbs up if you okay. Give me a thumbs down if you have questions. Okay, good, okay. All right, there's different calculations. I'm going to do this real quick. It's not heavily tested in the state exam at all. At the end of the pre-tax and after-tax, sometimes no, it's not. And neither is this. I just explained this mainly because you're going to deal with investors, right? So know about this. I have, like I said, the guy that last week that was going to make $400,000. And I explained to him, no, you're not going to pay based on $400,000. You're going to pay based on whatever's left after your initial investment. That's very helpful. People don't know these things, right? So knowing, there's a lot, see, it's not highlighted at all. So knowing the basics is very, very important. It's part of your real estate course. I cannot teach just what's on the exam. It's a real estate course, so I have to teach you all of it. Right? Some things I do skip on purpose, but the majority I do cover. Like for instance, this one. Look, investors have different ways to calculate things. As an investor, we have the return on investment, ROI. We have the cash on cash return. We have return on equity, ROE. Okay? Calculations are as simple as this. NOI divided by price. So if I bring home 9,300 and it costs me 350,000, right? I divide the 9,300 by the 350,000. That's my ROI. Okay. Cash flow divided by cash invested. I put $50,000 into it. Mortgage doesn't count. I put down payment 50,000, and it brings me $300 a month, right? So times 12 divided by my 50,000. That's my cash on cash return. Okay, this is all based on annual. Always based on annual. Okay. Return on equity, cash flow. So whatever it is a year. So let's say the 9,300 divided by the amount of equity I have. So everybody has, like, you can run multiple calculations, and every investor has different levels of acceptance of these returns. Okay? Everybody's different. I look at what I'm getting every month or at the end of the year. Some people look at, okay, no, it has to be based on the ROI, or it has to be based on cash return. There's a lot of people that are very focused on this, cash on cash return. Not too many on the ROE, but a lot of them on the cash on cash return. The ROE for me only matters if we're doing, like I said, a lot of HELOCs. So will the HELOC pay itself based on the cash flow? All right, stuff like that. So not heavily tested. In New Jersey, not tested at all. All right. Questions? Done. So it's final questions. No questions? All right, guys. So if there's no questions, we're going to end for tonight. Friday the 13th. Tomorrow we'll be here, right? No. So I'll be here because I have an exam tomorrow for some of my students. For you guys, don't forget it's on the 28th, right? Yours is on the 28th, so ready for that. And I hope you guys have an amazing weekend. Send me questions. The ones that succeed the best at the exam, like first time and things like that, the ones that ask me as you're studying, put a question mark, right? Then compile a bunch of questions and send them to me, right? All right. Have a great weekend, everybody. You guys, welcome, YouTubers. See ya.